Hi, this is Accounting 201, Journal Entries, Lots of Transactions, Part 1 of 2 parts. My name is Judith Paquette. I'm trying to keep these videos to under 10 minutes. That way I can eventually get them all up on YouTube as well as Canvas. We are looking at 13 journal entries. I will walk you through each one. Then we're going to do T accounts and trial balance. As a review, T accounts, debits on the left, credits on the right. They don't mean anything but that, left and right. And each account has its own T account. Cash has its own, accounts payable has its own, etc. And it just keeps track of what's going on in the accounts, the increases and the decreases. As we create the journal entries, we will then post them to the T accounts. And each journal entry will have at least one debit and at least one credit. And the journal entries, the debits must equal the credits, not on the T accounts, but on the journal entries. So here's a review of the rules of debit and credit. As we go through the quarter, we're going to be adding a lot more accounts. But I just want to be really clear here. Assets, liabilities, stockholders' equity, revenue, expense, dividends, these are account categories. Underneath are the accounts. So as we create journal entries, we can only use accounts. We cannot use account categories. And then here's the rules of debit and credit. If I want to increase an asset, I'll debit it. If I want to increase one of these liability accounts, I will credit it, and so forth across. Take a minute and look at the relationship between assets and expenses. Both of them are debited with increases. That's important to remember. And then the liabilities, stockholders' equity, and revenue are all increased with credits. So let's take an example company and do a bunch of journal entries here. The company I made up is Emerald City Graphic Designers. They were formed in 2013 with $75,000 from 3 investors in exchange for 75,000 shares of $1 common stock. The company, in the next 13 transactions, the company's going to rent a building, purchase equipment, purchase supplies, and then buy insurance. Some purchases will be for cash, some on credit. So look at the wording when we go through these journal entries, because you'll want to remember that for later. Later on, the company will pay some bills, and then finally they'll provide some service and be paid for it. It will then pay its employee. One customer will prepay for service to be performed in the future. Another customer will pay for service performed in the current month. Emerald City Graphic Designers will receive a bill in the mail, but not pay it yet. And finally, they will pay a dividend. Let's get started. Your job, should you choose to accept it, is create with me the journal entries, get out a piece of paper, stop the video if you need to, and practice, and then see the solution. Then go on and we'll complete the accounting cycle for this same company in the next videos. All right, let's start. Journal entry number 1. Emerald City Graphic Designers was formed in January 2013 with $75,000 from 3 investors in exchange for 75,000 shares of $1 common stock. And the journal entry is number 1. You're going to put the date in there. And here we go. Debit cash, 75,000, and credit common stock for 75,000. Cash goes up, common stock also goes up. And we're following the rules of debit and credit. January 2nd, 2014, Emerald City Graphic Designers rents an office. They pay 4 months' rent in advance, and the monthly rent is $1,100. So we're renting an office, the company is making an advance payment. So the money they pay has a future value, and it will be used for the next 4 months as their rent. So we're going to debit prepaid rent for $4,400, and we're going to credit cash for $4,400. Prepaid rent is an asset. We increased it with a debit. Cash is also an asset, and we decreased it with a credit. Next journal entry, Emerald City purchases computer equipment costing $5,600 with $2,000 in cash and the balance to be paid next month. So we've got cash involved, we've got a bill that we've got to pay in the next month, and we brought equipment in. There it comes in. All right, the equipment is increased. You know, the book is very specific. Sometimes it will say computer equipment or office equipment, and I'm fine with just the word equipment at this point in your studies. So debit equipment, increase that account. Credit cash, we decreased cash for $2,000. Credit accounts payable, we increased accounts payable by $3,600. Now it's important to note that when you make a journal entry here, the debits equal the credits. And by the way, this is called a compound journal entry, and it's called a compound journal entry because you don't have one credit, one debit, and one credit. You've got more than two accounts. But it's important to note that we increased equipment, we increased accounts payable, but we decreased cash. So when you make a journal entry, the increases do not equal the decreases. It's that the debits equal the credits. Emerald City graphic designers ordered $800 of art supplies and $750 of office supplies. Now they placed an order, and now's the time to ask, was there a transaction? Was there an exchange? And the answer is no. There is none. And I put no entry when I'm discussing this with you guys, but honestly, you don't need to do any entry at all. Okay, this will be our last journal entry for the video part 1, and it is Emerald City purchased $800 of office supplies and $750 worth of art supplies. I think I got that backwards. Okay, let's go back to that slide. We ordered them in transaction 4, and now we're purchasing them. That means they've been received. Okay, so now there's a transaction. We have received the supplies. So now we're going to say debit supplies and credit accounts payable. Why didn't I credit cash? Because it's on credit. We purchased it with the intent of paying in the future. Okay, this is the end of journal entries part 1, and your next video is journal entries part 2.